Here is something most retirement content will never tell you. The income bridge that looks the most attractive on paper is rarely the one that actually closes your gap. And the reason has nothing to do with the income range or the time to first dollar. It has everything to do with what happens after taxes, after healthcare costs, and after you honestly assess how much you are willing to build. That is what this video is about. Not a list of 8 income ideas, but a framework for figuring out which one or two actually make sense for you, given your timeline, your situation, and what the real numbers look like once the government takes its share. And believe me, they take their share. Before we go further, I need to plant a flag. There are some significant financial consequences hiding inside several of these income options. ACA subsidy implications are if you in the pre-Medicare window, Social Security earnings limits if you are collecting before full retirement age, Medicare surcharges you may not see coming. I'm going to cover all of that in detail later in this video, and you will want to stay for it because for some viewers, those factors change which option makes sense entirely. Welcome to Retirepreneur. I'm Kurt Rose, CPA, former CFO of an SBA lender and entrepreneur. We cover the financial mechanics of second act income for professionals 55 and over. If this is your first time here, subscribe below. This is education, not financial, legal, or investment advice. Let's get started. Let me start with what I consider to be the most important idea in this video. Most professionals approaching retirement are thinking about income in the wrong order. They are asking which income idea sounds interesting, or which one has the highest ceiling, or which one a colleague mentioned at a conference. That is the wrong question. The right question is which income source fits where you actually are right now, not where you want to be, where you are. And for most professionals in this audience, there is a logical sequence that makes more sense than anything else. It is not a rigid prescription, but it is a pattern I have watched play out repeatedly across careers. It runs like this. Phased retirement provides the first bridge while you are still connected to an employer. Consulting converts that momentum into independent income once the phased arrangement ends. Fractional executive work is what consulting often evolves into when credibility is established and predictability becomes more valuable than variety. That sequence, phased to consulting to fractional, builds on itself. Each step uses what the previous one created. The other income options I'm going to cover are real, and some of them are excellent for the right profile. But they do not follow that same arc. We will get to them. First, the arc. Phased retirement is the most underused option in this entire framework, and I want to spend a moment on why that matters. Every other option I am going to describe requires you to find new clients, build something new, or develop a market position you do not yet have. Phased retirement requires none of that. It is a negotiation with an employer who already knows your value using goodwill you have already built over years or decades. The structure is straightforward. You reduce your hours and retain a proportional income. In many arrangements, you also retain access to employer benefits, including health insurance. That last point is not a minor detail. For a professional between 60 and 65 who is not yet eligible for Medicare, employer-sponsored health coverage is potentially one of the most financially significant benefits available anywhere in this framework. Income through a phased arrangement is immediate. No ramp, no client acquisition, no proposal process. The income range is proportional to your current compensation at the reduced hours you negotiate. Here is the critical framing, though, and this is where most people who pursue phased retirement make a mistake. Phased retirement is a bridge, not a destination. Its value is not the income it produces while it is active. Its value is the runway it creates for building what comes next. Use that time wisely. So what does that runway actually build toward? Let's talk about consulting. Here's something you might not expect me to say. Consulting fails more often than it should, and almost never for the reason people assume. It does not fail because the professional lacks expertise. It almost always fails because the professional waits until after they have left their job to start building their consulting pipeline. By then, the network that was warm has started to cool. The introductions that would have been natural inside a professional context now require cold outreach. The momentum that existed while they were active has started to fade. The professionals I have watched transition successfully into consulting started having conversations while they were still working, not selling. Conversations. Telling people they were planning a transition, exploring what problems existed in their network, planting seeds before the ground went cold. Consulting at the senior professional level draws on expertise you already have and a network you have already built. There is no product to create before you can start. The income range varies significantly by specialty and market, but at the senior level, we are talking about hourly rates or monthly retainers that can meaningfully contribute to closing a retirement income gap. Time to first dollar is 30 to 60 days if the network is warm when you start. Here's the thing about consulting income, though. That retainer number is a gross number. And I am going to keep coming back to this point throughout the video because it matters. Gross income is not what closes your gap. After-tax income is. There are some significant implications hiding inside self-employment income that I will cover in the tax section. Flag it in your mind. We will get there. Fractional executive work is where consulting often lands once the credibility is established. But here's what most people get wrong about it. They treat fractional work as a faster version of consulting. It is not. They are different structures with different requirements, and confusing them is one of the more common early mistakes in this transition. Consulting tends to be project-based, episodic, and client-dependent. Fractional work is a defined part-time role with one company, typically on a recurring monthly arrangement. Fractional CFO, fractional COO, fractional Chief Revenue Officer. You own outcomes within the role, not just deliverables on a project. The income profile at the senior level can range from several thousand to significantly more per month, depending on the role and the company. The specific range is market dependent, and I would frame any number here as directional, not a guarantee. What makes fractional work valuable is not the ceiling, it is the predictability. Once you land a fractional engagement, the monthly income is more stable than stacking individual consulting projects. That stability matters when you are managing a retirement income gap. One note, fractional roles can be structured as W-2 employment through a placement firm or as 1099 independent contractor work arranged directly. The tax treatment is meaningfully different between those two structures. We will come back to that. Now let me step off the main arc and talk about the other options. Not because they are less real, but because they require something different from what the arc provides, and it is worth being honest about that. Coaching is not the same as consulting, and that distinction matters more than most people realize. In fact, I would say coaching is the option most frequently chosen by professionals for the wrong reasons. They choose it because it sounds flexible and personal and high value. All of those things can be true. But the path to making it work is almost nothing like what people expect. Consulting delivers your expertise to organizations, coaching delivers it to individuals. The hourly equivalent can be higher if the practice is priced correctly and positioned well. But here is what the income range alone does not tell you. Coaching requires building a practice, not just delivering expertise. You need a positioning system, a client acquisition approach, and a way to communicate the specific transformation you provide. I have watched experienced executives try to launch coaching practices and struggle not because they lack knowledge, but because they approached it as if expertise alone would attract clients. It does not. Coaching is a business that happens to use expertise as its product, and building it takes 60 to 120 days at minimum to see first revenue. And that assumes your network includes potential coaching clients. If that description resonates with you, coaching can be an excellent income source. If it sounds like a significant amount of new work on top of figuring out retirement income, that is also a legitimate read. Not every option makes sense for every professional. Cohort-based courses are the most misunderstood option in this framework, and probably the most oversold in general retirement content. Let me say something that most people selling course programs will not say. Most professionals should not build a course as a primary retirement income strategy. Not because courses cannot generate income, they absolutely can, but because the prerequisites are significant and most people underestimate them. A successful cohort course requires an audience you can sell to before you build anything. It requires curriculum development, it requires the ability to market and fill a cohort, and it requires subject matter positioned specifically enough that people will pay to learn it in a structured format. If those prerequisites exist for you, the leverage potential is genuinely the highest in this framework. Revenue can repeat across cohorts without proportional increase in your time. The ceiling is real. But the runway to first dollar is 90 to 180 days at minimum, and that assumes you validate the concept with paying participants before building the full curriculum. Sell before you build. That principle is non-negotiable for courses. Do not spend months creating content before a single paying participant has committed. Board and advisory positions. Everyone in transition hears this advice. Get on some boards. It sounds low effort and prestigious. Here's the more honest picture. Advisory boards can range from entirely unpaid, compensated only with equity, to tens of thousands of dollars annually for the right profile. Private company boards can pay more. Public company boards can pay significantly more but carry fiduciary and compliance obligations that raise the stakes considerably. The honest caveat is this: board positions are almost entirely relationship-driven. You do not apply for board seats in any meaningful sense. You get introduced, you get recommended. And those introductions typically require either a known reputation in a specific sector or a warm relationship with someone who is already in the room. For the right profile with the right network, board income is genuine and can be excellent supplemental income over time. For someone starting to build in this space, it is rarely a primary gap closer in the near term. Think of it as a layer on top of something from the main arc, not a replacement for it. Paid speaking. Here is the real picture on this one. Most senior professionals have far more expertise than their current speaking profile reflects. That gap is real and can be closed. But closing it takes positioning work that is separate from the speaking itself. You need a topic, a defined audience, and a visible track record of delivering value on that topic in some public format. Writing, video, keynotes, something. Local and regional events are the realistic entry point. The income there is real but modest. Conference circuits pay significantly more but take longer to access. Most professionals entering this space should treat early speaking engagements as credibility investments rather than income generators, because that is what they are in the beginning. If speaking amplifies your consulting or fractional positioning, which it absolutely can, the income is a secondary benefit to something more valuable. Referral brokering is the final option, and honestly the one I am most cautious about naming as a retirement income strategy. Not because it does not work, it does for the right professional, but because it is the option most likely to produce zero income for someone who builds a plan around it without the right conditions already in place. You leverage your professional network to connect businesses to resources they need, capital sources, strategic partners, vendors, acquirers. You earn a fee on the introduction or the transaction. The income range is genuinely unpredictable because it depends entirely on deal flow and the density of your relationships in a specific industry. For professionals with deep, active network capital in industries where deals happen regularly, this can generate meaningful income with minimal time commitment. For most professionals, it is a parallel activity rather than a primary strategy. You cannot build a retirement income plan around income you cannot predict. So far, every number I have given you has been gross. That is about to change. Now, the tax section. This is where everything changes. Every income range I mentioned in the last several minutes was a gross number. What closes your retirement income gap is the after-tax number, and for self-employed professionals, those two figures can be meaningfully different. Here are the 4 things that change your real number. The first is self-employment tax drag. When you earn income as a self-employed professional, which includes consulting, coaching, courses, speaking, and brokering, you are responsible for both the employee and employer portions of payroll taxes. The Social Security portion applies at 12.4% up to the 2026 wage base of $184,500. The Medicare portion applies at 2.9% on all net earnings. Combined, that is 15.3% before income tax touches the calculation. To make this concrete with a rough illustration, a $5,000 monthly consulting retainer does not produce $5,000 of take-home income. After self-employment taxes and before income tax, you might net somewhere in the range of $4,000 to $4,200 as a simplified estimate. Your actual result depends on your deductible business expenses, the specifics of your tax situation, and your state. But the principle holds. Gross is not net. Run your own numbers with a tax professional. The second is the Social Security earnings test. This only applies if you are collecting Social Security benefits before reaching your full retirement age. If you have already reached full retirement age, there is no earnings limit. Skip this one. For those collecting before FRA, earned income above certain thresholds reduces your benefit. In 2026, the limit is $24,480 if you are under full retirement age all year. In the year you reach full retirement age, the threshold rises to $65,160, but only for earnings before the month you actually reach FRA. The reduction is temporary, not permanent, but it affects your monthly cash flow when it hits. If you are collecting benefits and planning to generate earned income, verify the current limits with the Social Security Administration or your advisor before you start. The third is ACA subsidy planning, and this is the most important factor in this section for viewers in the 60 to 65 window who are not yet on Medicare. If you are receiving advanced premium tax credits through the ACA marketplace, any income you generate from consulting, fractional work, courses, or any other source counts toward your household income for subsidy purposes. For 2026, the excess APTC repayment cap has been removed, meaning if your actual income comes in higher than what you projected at enrollment, you may owe back a significant portion of the subsidies you received without a ceiling on that repayment. The planning implication is direct. If you are in the pre-Medicare window and receiving ACA subsidies, income design is not a background consideration. It is a foreground one. A new consulting engagement or an unexpectedly good course launch could generate a tax repayment obligation you did not anticipate. Verify your specific situation with a tax professional or a health insurance specialist before you start generating new income. The ACA rules in this area are specific to your household income level and your state, and they change. Do not guess on this one. The fourth is Medicare and IRMAA for viewers who are already on Medicare. Income above certain thresholds triggers premium surcharges on Medicare Part B and Part D. The surcharges are meaningful, and they apply based on income from 2 years prior. If the income sources in this video push your household income above the relevant thresholds, your Medicare premiums will increase in a future year. Factor that into your planning, not as a reason to avoid income, but as a number to account for. One more thing in this section. Once your net self-employment income reaches a meaningful level, an S-corporation election is worth discussing with your CPA. The basic mechanism allows you to pay yourself a reasonable salary, on which payroll taxes apply, and take remaining profit as a distribution, on which they generally do not. At the right income levels, the annual savings can be significant. This is a dedicated CPA conversation, not a DIY decision, and it deserves its own video. Now, the decision filter. If you need income within 90 days, the answer for most professionals is phased retirement if that option is available. If it is not, start with consulting. Build fractional as the second step once consulting credibility is established. If you have 6 to 12 months, add coaching or a cohort course alongside a bucket one anchor, not instead of it, alongside it. If you have network leverage and lower urgency, layer board work, speaking, or referral brokering as supplements to something from the main arc. These are not primary gap closers for most professionals starting out. Here is the frame that ties all of this together. The mistake is not choosing the wrong income bridge. The mistake is thinking you only need one. For most professionals in this audience, income design is a sequence, not a single choice. You start with the option that fits your current position. You build the next option while the first one is funding your runway. And over time, the combination of what you have built produces something more stable, more flexible, and more sustainable than any single source ever would. The best income bridge is not the one with the highest gross income. It is the one that closes your actual gap after taxes, after healthcare costs, after honest accounting for the time and energy it requires. Your decades of expertise already have a market price. The question is, which structure extracts that value most efficiently for your specific situation, your timeline, and your life? If this was useful, subscribe. I publish new videos every week on the financial mechanics of building income after 55. Your expertise is worth more than you think.